Are you a first-time home buyer feeling overwhelmed by the mortgage process with prices being high, rates being high, all the paperwork, credit scores? It definitely can be overwhelming. That's why on this episode, we're having a conversation with a local lender who shares tips and tricks with us to help you get the best loans and best rates possible and to help make your dreams of home ownership into a reality. Hello, and welcome back to the Happy House Hacking Podcast, the podcast designed to help young people in California navigate the path to happy home ownership. I am your host, Owen Schwegerly. I am a realtor, investor, and happy house hacker. And on today's episode, we will be having a conversation with Ben Lerner.
Hi, Owen. Nice to be here. Thank you.
Yes, thank you for being here, Ben.
My pleasure.
So Ben is a local lender that we've worked with many times in the past, and he's going to be sharing with us more about financing. So Ben, tell us a little bit about yourself and how you got into lending.
Sure. I got into lending about 20 plus years ago now, 21 years ago. And it just I was in sporting goods and I was buying and selling homes. And it just, I liked the lending part of the transaction. And so I decided to make a change.
Okay. So you've been lending now for 20 years.
Correct.
And tell us where you are today and what you currently do.
Yeah, I'm with Certainty Home Lending. We're a division of Guaranteed Rate, so the second largest lender in the country. And I'm a producing branch manager here in San Luis Obispo, California. And we have 12 other loan officers, and we process and underwrite in our office. So we're a self-contained unit for lending, as opposed to somebody that sends out their business and has other people touch their files. We're kind of like the local, we're control freaks and we like to do it all ourselves.
Okay. So if I'm a buyer, like first time buyer, I want to get started. I'm just feeling overwhelmed because prices are high, rates are high. And like, what do I do? What's the first step for someone thinking about buying a home?
Yeah, that's an excellent question. You know, I hear a lot of first-time homeowners or even people that have gone through it before, but think that their situation may be limiting or, you know, they don't think they're ready. I always encourage them. The first thing to do is to get in front of me and have a conversation. My job is to help them prepare and to guide them through the process. It's not simply to write a check and fund their loan. And so the first thing I would say is if you're a prospective buyer or a first-time homeowner, or even if you're doing it again and you're just not sure about what your situation is, my job is to help you be prepared and to do that. And so I would say the first step is to always just place a call and not be intimidated to do so.
So a lot of times I hear, well, I don't want to talk to a lender yet because I don't want them to pull my credit. It's going to hurt my credit score. I'm working on my credit right now, or I'm working on my down payment. So I don't want to talk to a lender. What would you say in that situation?
Yeah, we don't do a hard inquiry on credit unless somebody is in contract or they want us to. We do what's called a soft pull. And that's not an inquiry. It doesn't hurt the score. It doesn't show up on their credit report as such. And it gives us all the data that we need to do to analyze their debt service and their payment history and their capacity to take on a loan.
Okay. So this is the Happy House Hacking Podcast. We are all about the house hacking strategy. Our first home was a fourplex. Our current home, we've got set up where we're renting it out. It's covering half the mortgage. So we're all about helping people get into house hacking.
Love it. Yeah.
So what are some strategies or loans that a buyer could take advantage of today that could help them get in on a house hack like that?
Yeah, some programs that are for first-time home buyers are tricky for multifamily. Some allow what's called border income, which is when you buy a home and you have rooms rented out. Those are very limited though, but there are single family homes that you can use rental income, especially if there's already a tenant in a house. We've done a loan where a room is rented out, that tenant wanted to stay and the buyer wanted them to stay. And so they stayed and we were able to use that income. And that would be a program like Fannie Mae's Home Ready, which is a first-time home buying program. It's actually can be used not just first time, but for any buyer. But there are programs that do even allow border income when you have a single family. Other programs are based on income qualifying for first-time homeowners, and they can give quite an incentive to help somebody. And that kind of comes back to what you were just asking. Let's say you've got a client who is feeling like, I've got some derogatories. My credit history hasn't been great in the last couple of years. I know my credit scores maybe only in the mid 600s or something, and they could be intimidated. There are some really good programs for that, and I can elaborate if it's relevant.
Okay, let's go back to border income. That's
Yeah,
a super interesting concept
yeah.
because we were recently trying to get a deal for a client, and it's a 2-bedroom condo, and they were hoping to use some of the income to help them qualify for the loan. Lo and behold, the lender we're working with says, "Oh no, we can't use that." So you said it's a little complicated. So how would someone actually use border income to qualify?
Yeah, for a program like Home Ready, which is the primary one that comes to mind that does allow border income, I believe it has to have a history of currently being rented. And if you have that and you have a situation where there's a roommate there, you've got a signed lease agreement, you can count that border income towards you'd use 75% of those rents to offset the payment so that it's easier to qualify for the client.
So you need a current rental history on that building.
Correct.
So if it's vacant, it kind of wouldn't work for that.
It can be difficult. I don't believe on Home Ready, I'd have to verify. I don't believe there's a way to use border income if it's been vacant and you're simply going to lease it as you buy it. You would need to have it. I believe it has to already have a history of lease.
Okay. So then in that case, it might work better for like a duplex.
Absolutely. For a duplex, it's very easy because on a duplex, you can have a situation
Separate unit.
Correct. Now, Home Ready is only for single family residents, but there's another program called LLPA waiver, which is horrible name. LLPA stands for loan level pricing adjustments. And it's an amazing program. It is an adjusted median income based program. So in our county, we are what's called a high cost county. And so in our county, the adjusted median income is about 125,000 this year, just got increased. And we can go to 120% of the adjusted median income, which is just over 150,000. And so this program, household income or the people that you're using on the loan can make up to 150,000. And the program eliminates all the add-ons to rate that occur. And I can elaborate on that for a quick second. So let's say you are buying a manufactured home, you're only putting down 5%, and maybe your credit score is 650 on using FICO. Somebody like that would have a horrendous rate relative to somebody putting 20% down, buying a single family home with perfect credit. The LLPA waiver program, if they qualify using this adjusted median income number, 150,000 or less income, they get the same best rate as if they had perfect credit, putting 20% down, all of those things.
How does that happen? Like, where is this LLPA waiver? Because obviously someone's making up the difference, right?
It's a Fannie Mae and Freddie Mac program.
Okay.
And it's termed a first-time homebuyer program. So that program is only for first-time homebuyers. And it's an amazing, I've literally done deals with people with much worse credit than that, buying a manufactured home with a minimal down payment where the best rate might have been in the 8s with points. And all of a sudden they get something that's in today's rates at the best range. So it's an amazing program.
Yeah. That's cool.
Yep.
Okay. So now tell us more about multifamily because the border income sounds like very limited options, but if you're buying a duplex or triplex or fourplex, that's still considered single family. Correct. So tell us a little bit more about the options for buying, because I believe when you get a duplex, it's easier than the fourplex. You need more, or the self-sufficiency test, meaning it has to support its own.
Correct.
So explain more on that.
Yeah. So you have two different types of loans, basically. You have government and bond loans, and then you have conventional financing, which would be like a Wall Street saleable loan. On the government loans, FHA would fall into that category. And the most common, you could do an FHA loan with 3.5% down for up to 4 units. But as you said, if you exceed 2 units for 3 and 4 unit properties, you need to do the self-sufficiency test, which basically, like you said, it means that the property has to support itself without any rents. And it almost never, with today's interest rate environment in California, it doesn't fly. I haven't seen one in a few years
Wow.
that works. So you can do basically FHA, I would say, is for 1 or 2 units, and it's still
Mm-hmm.
a great product for that. Um, if you A couple of months ago, though, Fannie Mae and Freddie Mac changed their guidelines so that you can do conventional financing. While it's not 3.5% down, it's 5% down, and you can go to 4 units, owner occupied, to 4 units now with 5% down, and there is no self sufficiency test. So you can do conventional financing and do the house hack.
So you could get 4 units for only 5% down.
Correct.
Wow. That's
And no
awesome.
test for self sufficiency.
Right. And so when people are thinking, oh, I can't get into a multifamily or a house hack, it's just too expensive. Well, now there is a new loan with only 5% down.
Right. Used to be 20%. So
That's
it's a big change.
huge. So that will really help people get in.
Correct.
And then even if the rental income doesn't totally cover the property, if you're able to cover even just half your mortgage or a third of your mortgage, that's going to go a long way helping you save money to build wealth, to have financial freedom.
Yeah, absolutely. The numbers, we crunch the numbers all the time, as you're saying, with clients who are considering, do I buy a condo for 600,000 or 700,000 or a single family for maybe 800,000 or 900,000 to start out on? Or do I look at a multifamily for maybe 1.2 or 1.3 and I have this rent coming in? And normally the numbers crunch much better on the multifamily, much lower for their outlay. I always caution, as I'm sure you do, is just be sure you're prepared for some reserves. If you're a multifamily owner, you definitely want to have something in the bank for reserves, just for the unexpected. A plumber in a unit or something.
Okay, totally. So then we've talked about some of the first time buyer programs, some of the multifamily house hacking programs, which is awesome. What about closing costs? I mean, this is kind of a big thing, especially since they've decoupled the real estate commissions and now buyers are also going to be responsible for their buyer's agent commission in a lot of situations.
Right.
And it may be considered just part of their closing costs. What are lenders doing in regards to buyers' closing costs going up? Which, I mean, buyers are already like maxed out. I got to save up a down payment. I have to save up closing costs. Now I have commission on top of it. So what are lenders doing around helping buyers on closing costs?
Yeah, I mean, until yesterday, the only program that wasn't allowing the pass through of those commissions through the client. So say a seller agrees to pay the buyer's commission for the buyer's agent. VA wouldn't allow that to pass through on the settlement statement. As of this week, a service bulletin came out and VA is now allowing that. So all of the programs now, all of the loan programs do allow, if a seller agrees to, say, a $20,000 credit through closing, it can pass through it beyond closing costs. It could pass through the buyer to the buyer's agent. So that does now happen. So it can help do that. VA had some weird verbiage on the service bulletin, and I don't want to get ahead of myself because it's brand new and we're waiting to get the interpretation. But it does seem like they're implying you could finance the buyer's agent fee, which would be wonderful, and that would be in line with VA because they would always want to try to do everything that's in the service member's best interest. That's the VA guidelines. And VA is another one that you can actually even exceed 4 units on, but for practical purposes, you can do, if you're a veteran or a service member, which is something I focus on, you can do 100% financing on a 4-unit purchase.
That's great. Way to go for helping our vets.
Absolutely.
I mean, that is awesome. So, okay, let's talk about interest rates. Where are interest at today, and what are some things that maybe you're doing to help buyers get in? Because rates are pretty high. So let's talk rates.
Yeah. It's a good day to talk about rates. As we're recording this, we're waiting for the Federal Reserve to announce their June policy statement. And it's expected to hold rates steady, but we're waiting to see what their direction is and what we call the dot plot, what their forecast is for the future. Are they still planning 2 decreases this year on the federal funds rate, or are there more? So today's a big day for that. Coupled with this morning, we got what's called the personal consumption. The PCI came out this morning, not the PCE. Inflationary data came out this morning, and it was supportive of it was a softer reading. So inflation moderated in this reading this month. And it's a favored report for the feds. So at the same time that they're having their meeting today, deciding whether to adjust rates and how
Mm-hmm.
their tone is going to be in the statement, we got some pretty good data today supporting lower rates, which was encouraging.
Cool.
So rates today, to get to your question, are going down nicely this morning, and hopefully the statement today will be dovish and will encourage more of that as the afternoon goes on. But we're in the very high sixes for a clean loan today. If you were doing a government loan like VA or FHA, we're right near 6% today. So they're about 1% better today.
Mm-hmm.
So much lower. And I do expect the trajectory. I think it's going to be a hard few months still where it's probably going to moderate a little bit, not too much of improvement. But I think by the end of the year, we'll start to see some really good improvement, just as inflation and employment data kind of supports lower rates.
Okay. That's great to hear. Now, when it comes to buying a property, buyers have options. Like they can just like take that rate or they can buy that rate down.
Correct.
So could you explain to us maybe some of the pros or cons of looking at these rate buy down programs and if they're really worth it?
Yeah, there are two ways that you can do buy downs. Essentially, you can do a permanent buy down, which is when you hear somebody, well, pay a point and it lowers your rate in 0.25%, and 1 point equals 1% of the loan amount. So if you're doing a $500,000 loan, 1 point is $5,000. Traditionally, and it changes every day, but traditionally, a point buys you about 0.25% reduction in rate. So instead of being at 6.75, it may buy you down to 6.5%. There's a recovery to that. In that particular formulation, it's about a 5 to 6 year recovery of the cost. So in other words, the cost $5,000 divided by the monthly savings by the lower rate, it's going to take you over 5 years to recover that difference. So that only makes sense if you think you're going to be in the loan for that term.
Mm-hmm.
Right now, with the current environment, with rates improving, it's more likely that you're going to be refinanced in the near term. Now, one of the things, and I'll get to temporary buy down, one of the things our office does is if you do a loan with us at 500,000 or higher, we do a no cost refinance, and there's no voodoo to it. We simply get paid much less as loan officers on the refinance so that we can cover the closing costs. And so we do no fee refinances.
Wow, that's awesome.
And that's to encourage that we want to keep you in our clutch, and that encourages people not to be as limited by the rates. Going back to the other type of buy down, we talked about permanent, would be a temporary buy down, which is very popular right now. And a temporary buy down is to buy the rate down for 1, 2, or 3 years, and it's generally paid by the seller, and you buy it down in percentage increments. And it works out to be a 1%. So let's say you're at 6.75 and you do a temporary 1 year buy down. It would take the rate, the effective rate to your buyer, to 5.75 for the first 12 months. And the cost of that to the seller or to whoever pays for it is about 0.8 of a point. So going back to our same $500,000 scenario, a 1 year buy down is about $4,000 on that loan. And that takes them down 1% for the first 12 months. The beauty to that compared to a permanent one is, A, it's a lot bigger buy down. So it's a big difference, 0.25% on maybe on a permanent buy down versus 1% on a temporary for less money, but it's only temporary.
Mm-hmm.
But on a permanent buy down, if you refinance in 6 months, you've lost the money that you spent to buy it down. There's no recoup of those funds. On a temporary buy down, using our example, somebody, and I'm sorry, this is a little bit wonky, but using our example, somebody does a $500,000 loan. They do a 1 year buy down so that they're effectively 1% lower, and that cost roughly $4,000. Let's say 6 months into their loan, rates have dropped enough that we refinance them, and they've only used up half of that temporary buy down. So that $4,000 temporary buy down, if in 6 months they would have used about $2,000 of it, so there's still $2,000 of their buy down left. It's treated like a separate part of their loan.
Mm-hmm.
If they refinance, that $2,000 gets applied to their principal.
Sweet.
So they do get to recoup all of the funds.
That's pretty cool. So you can kind of like play the game. We don't know for sure, but if rates do continue down, you could get a temporary buy down to soften your payment for the first 1-2 years. And then I can just refi once rates drop to maybe 5%, get a permanent loan at that amount, 5 or 6.
Exactly.
And roll forward the cost that you paid to get that buy down.
That's right.
That's amazing.
It is. There's nothing lost on a temporary buy down.
And if you structure it right, you can get the seller to pay that cost, right?
Exactly.
So now we're just getting the seller to give you the equity into your new loan.
That's exactly right.
That's pretty sweet.
It is.
What's the cost? I mean, like, what are the downsides of that?
There's really no downside because it's money back in your pocket. The first thing I would cover would be closing costs, because either way, that's money back in your pocket.
Yeah.
And then the second thing would be working on the temporary buy down. So I have had clients that say, no, it's not the closing costs. I just want the monthly payment. It's the same thing. If you outlay $12,000 in closing costs, it's the same thing. If that's covered, you just kept that $12,000. So even if you're paying more monthly, you have more money to make that payment. There is a feeling that's different, though. Some people just want the lower effective monthly payment. So
totally. Okay.
But logically, I would say cover closing costs first and then the buy downs.
Okay. Got it. So, and then I guess if you were a young person getting started today and kind of knowing what you now know, I mean, what would you do as your next step?
I would say if you're unsure of what to do, all of the data that we're discussing, all of these programs, the interest rates, my job as a banker, my fiduciary responsibility to you as the client is to ensure that I find the best solutions for you. So as a banker, I'm not paid by the loan program, the interest rate. My job is to look after your clients. So if somebody is on the fence or feeling like they don't know what's the next step, I would say call and make an appointment and meet with a lender.
Awesome.
Yeah.
Well, thank you, Ben, for coming on the podcast
my
today
pleasure.
and sharing your knowledge and wisdom with us.
Thank you very much, Owen.
And to all you happy house hackers out there, thanks for tuning in. Please like and subscribe to our show. That way you can get all the new content that we're dropping, all the great interviews that we're having. And if you want to take that next step and learn more about the home buying process or selling a property or house hacking your way to financial freedom, send us a message. You can DM us and we can set up a free consultation and we can get you connected to a great lender locally who can help you get prepared to buy your next home. Thanks so much for tuning in and we'll see you on the next one.